Greetings everybody and welcome to class, and in this video we're going to go ahead and talk about accounting methods for tax. Let's hit it. All right, everybody, welcome back to class. And in this video, we're going to talk about applying cash and accrual methods to determine accounting business income and expense deductions. So you'll notice that when it came to the last video, we really kind of talked about accounting periods kind of in general. This is where we're going to really apply this stuff towards tax a lot heavier. And so that's why this video is the way that it is. I think in the past we used to merge these two together, and I'm actually kind of glad they brought these two out because, again, accounting periods. When I did my master's in tax, there was actually an entire class I could have taken just on accounting periods. So it's a big topic in tax. Okay, usually because people are using it to play shenanigans, and so that's why it gets done. All right, so choosing your accounting method, it's done by if you choose a permissible method and it's adopted by using and reporting in the year for 1 year. An impermissible method is adopted and using and reported for the year for 2 years. So you might say, wait a minute, hold on just a damn minute. Kevin, you're telling me I can do an impermissible method, in other words, one that I'm not allowed to do, and it may stick? And the answer is yes. Okay. So for example, where we tend to see this a lot really is depreciation. What ends up happening is that somebody befuddles and chooses the wrong depreciation method for something because, it sometimes gets a little bit complicated. Is something a 3-year asset, a 5-year asset, a 7-year asset, whatever. So if you choose to depreciate something over a period of a particular way of doing things, and you want to swap back to something else, once you hit that 2-year period, and because it's impermissible, you now have to ask IRS permission. Now, they'll grant it to you because you're trying to fix something that went wrong, but it's going to take a lot of paperwork and it's going to take a lot of heartache on your part. So, for example, like I said, depreciation. You buy a house and you're going to turn it into a rental property, and you go in there and you buy the house including all the furniture and everything else, and you pay one price for it. And you go ahead and you say, okay, I'm going to take 20%, put it to land, 80%, put it to the building. It's a $1,250 asset. We're going to depreciate over time. Client comes to you and says, okay, Kevin, hey, while I was on vacation, I ran into this guy who was talking about doing these things called cost segs. Cost segs are short for cost segregation studies. So what that means is you go in, you buy a building that has a whole bunch of furniture in there. Well, furniture is a 1245 asset. So what you can do is you can say, I paid this much money for my total asset, of which this much of it, fair market value, we'll say on my rental property, I paid, $400,000 for it. But the furniture that's in there is actually worth $100,000 or $50,000 or $25,000. We'll say $25,000. By breaking that out, what I can do is I can convert it to 1245 property, and I can go ahead and expense it immediately under Section 179. Okay, can save you a lot of money, particularly if you're, and where you see cost seg studies really happen are in business buildings, like commercial real estate. So they go out and they're buying a building for, $15 million, inside which they may find $1 million worth of furniture. Well, that $1 million can write off immediately. That's a huge savings for them. Okay. And so they'll hire these companies that's all they do is travel from, client to client to client. And they do these things called cost seg studies. Okay. But if he comes back to me 3 years later, 5 years later, and says, hey, I think we should have done this cost seg study, we can go back to the IRS and say, well, it was impermissible, so we can go ahead and we can do a change. It'll be a 3115. You're going to pay me $2,500 to do it. My question then becomes, hey, if we do this, am I going to save this client enough money in order to be able to justify it? Okay. Now, if the guy went in and he bought like $100,000 worth of stuff, yeah, $2,500 might justify it because he can write off, $100,000 if he's a max tax rate taxpayer. That's $37,000. That's $37,000 as a tax write-off. Is he going to pay me $2,500 to do that? Yeah, it's my good friend Shrenvisha. Yeah, sure, you betcha. Okay. So, again, a lot of times when we're trying to figure out if we want to really do some of this stuff, we're going to do this based off of, hey, is this going to save the client money? Now, you might go back and say, well, Kevin, if there's furniture in there, then you were wrong to do this. You should be willing to fix it for free. Well, number one, we don't do anything for free in this business unless it is a mistake. And so you think I made a mistake in doing this. Well, not really. Okay. Because again, when the client comes to me, maybe the client didn't tell me there was furniture inside. Okay. Maybe I didn't know that, because usually when people buy houses, they don't buy furniture to go with it. They'll buy it separately. Okay. So, again, facts and circumstances. Got to know what the story is, folks. When you do a change of method, some are automatic. Depreciation is usually an automatic change. And so if you do a Form 3115, you're going to go code 7. That's going to send it off. And by the way, I've actually talked to the person who processes all of them for the United States. And yeah, there's only one guy. Okay. Really nice guy. Don't get me wrong. He loves talking about 3115 change of accountings. Like I said, he's really nice. Actually, if you want to know who he is, you can go look up RevProc. It's usually the first RevProc of the year. So you go find out, 2023-01. You can go down to the bottom. You can actually find his name. I'll be honest. I haven't called him since 2020. So if he's been replaced and there's a woman there, don't get mad at me for misgendering somebody. So there's that. Permission may be necessary to correct the use of an impermissible method. That's for specific ones. And again, these RevProcs, the first of the year, which is usually dealing with change of accounting, they're going to be the ones who are going to tell you, hey, these are going to be the areas where you're going to need permission to do this. And then there's others where we're going to say, this is 100% automatic. You do it, we'll go ahead and accept it. Okay. Financial tax methods, again, when you're reporting it, select accounting methods permissible under GAAP that accelerate income and defer deductions. That's what financial guys want to do. In contrast to tax, we want to get a low tax bill. I want to save as much do-re-mi emphasis on me. And therefore, what I'm going to do is I'm going to say I want to defer income and accelerate deductions. So, there's always this back and forth that happens between the tax people and the financial people as to what's best for the business. All right, so then you have this, the permissible overall methods, again, cash and accrual. If you do cash or accrual, as long as you don't, you can't do it if you're a large taxpayer. And that gets back to that $29 million rule that we talked about before, that I brought up in the other video. Okay, so you have to satisfy that gross receipts test in order to elect the cash method. Gross receipts test got to be lower than $29 million. Okay. Cash method income is received when actually or constructively received. What do I mean by constructively received? Somebody mails me a check. It sits on my desk. I don't cash a check for 3 weeks. 3 weeks is the amount of time between December 20th and January 5th when I get around to going out to the bank. Technically speaking, in those cases, that's the way it is, okay? So the expenses will be recognized when paid. The pros are that it's flexible, it's simple. Usually when we talk about this, cash method, we're really talking about sole props. A lot of these guys don't like accounting. They don't know how to use QuickBooks. They're just going to go in, they're going to do whatever, and maybe they take a rudimentary QuickBooks class. But for the most part, they're going to basically come to you and say, here's what I got. Help me figure this out. So, again, if it's been paid, fine. If it's been received, fine. If it hasn't been, put it on the books, but you're not putting it in your tax return. There are poor matching. So, for example, if I spend an exorbitant amount of money, a very good example, I actually have a client that I do their 1099 work. We start in November, and we spend something to the tune of about $1,900 to do their engagement, which the total engagement is about $7,500 when we get all done. That $1,900 oftentimes is spent up front. Okay, and so with that, we don't Yeah, it's one of those things that we want to make sure that, not want to make sure it's not going to match up. Okay. Conversely, if I was, if I was doing this and then, the person was going to give it to me, I could go ahead and say, look, you've already signed the contract. We're going to go ahead and say that the bill's due as of when the work is complete. Okay, but I'm going to go ahead and I'm going to bank those things until we get done with everything as is. Okay, so again, you could have that issue. Some can use accrual for some accounts. That's if you're going under the hybrid method. We talked about that, and can be used by taxpayers to satisfy the gross receipts test. That's true. Accrual income is received when recognized when earned or received. All events test. Yeah, so what happens is, again, I got to complete the work, send the invoice out. That's when I'm going to receive the thing. But the work's got to be complete first. I can't go give the guy his invoice up ahead of time and call that income to me. Okay. Now, I've had it where they've tried to get me to do the invoice. I won't do it because, in my opinion, it's unethical. But, that doesn't mean that you won't have clients, so at least try. Okay, now clients can go ahead and pay in advance all they want. Okay, they can pay in advance all they want. It's just that, that's just kind of the way that works. Okay, recognize again on the earliest of these days, completion of the service, payment is due, payment is received. Now, payment is received, not necessarily. Okay, again, if they're doing prepayment, that's prepaid income. And you could be required to put it on your books today, but you may be qualify for a deferral. Okay, don't automatically assume that that you can do that. Okay. Accrual question: provides consulting services, bills ACE for $12,000. ACE disputes the amount, claiming $8,000 is proper. How much should he recognize under the accrual method this year? Well, let's be honest. First of all, is ACE right? Assuming ACE is correct, what should he recognize? Well, he should recognize that it's 8. Okay. Now, you can do this one of two ways. One, you can deduct, you can just redo the invoice at $8,000 and move on. 2, you can set up a bad debt. Although I don't think that's really probably an appropriate way of doing this, because if it turns out that Ben was wrong in sending out a $12,000 invoice, that's not really a bad debt. Okay, or you could do what's called a credit memo. Okay, now I would still put it into the same period as it comes into. But there's various methods that you can do with this, but it's going to go down to that 8,000, provided that it turns out to be true. Okay. Advanced payments for goods and services. Again, you can defer for and that's what I was talking about. If I get $1 million, I'm going to sell something to somebody overseas, and they know that I have to go out and purchase some of that material for them, so they're going to pay me some of my money up front. That's good. That can be deferred, providing that I'm going to, I can defer it only for a year. Once we get past a year, I can't defer that anymore. Okay. It's not applicable to payments relating to rent or interest. That's true. And this is an accounting method election that cannot be changed without permission of the IRS. That is also true. Although I don't know why you'd want to change it. Ben provides dancing lessons. Boy, was a consultant and does dancing lessons. Wow, that's really good. On September 30th of this year, he receives $2,400 full payment for a 2-year service contract. If he's cash method, he's going to recognize it today. There's nothing he can do. Accrual method goes beyond the 2 years. I would probably say he can elect to defer services for a year. So you'd recognize $300 now, and then the remaining $2,100 can be deferred only for 1 year. Okay, that's how this kind of works out. All right. For businesses occurring expenses, you have to have the all events test. In other words, it has to have occurred to establish the liability is determinable with reasonable accuracy, and reserves for future liabilities are not allowed. What that means is, you don't see that, well, actually, I've seen it a couple times in companies. They know they've got some big thing coming up. we're going to redo the building foyer. And we know it's going to be, $500,000 to do that. So what we're going to do is that we're going to apportion a part of our retained earnings, and then we're also going to apportion part of our, we're going to put up a savings account. We're going to start sacking some money away. Okay. The sacking of that away does not allow you to say, hey, I got a reserve for this, I can expense now. That's not how this works. You have to have the work actually done, and then you have to have invoice in hand. Okay. Economic performance does have to occur, is basically what we're saying here. Okay. All right, folks, so that's it. I want to say thank you very much for watching this video. And if you have any questions, feel free to reach out to me. And look forward to seeing you guys in class.